Farms.com Market School with expert commodity analyst Mo Agostino is an online educational video series designed to help you, the farmer, improve your knowledge of grain marketing. Farms.com Market School is brought to you by DeKalb Brand Seeds. DeKalb, growing confidence. Today's video is part one of two, where we're going to recap and summarize all the videos, the 30 videos we did in this educational video series. Our topics today include seasonality, knowing your cost of production, getting to know basis, watch what the speculators are doing, keep an eye on China and political landscape, and also take into account currency. So our first topic today is seasonality. Here's an example of seasonality in grain prices with corn. We've gone through this before, but remember, we tend to peak through the spring, summer months, some years earlier, some years later, and we tend to hit the lows usually around the end of September, October. Marketing is more of an art than a science, and we cannot predict the future. Don't even try. There's no specific model to follow, and every year can be different. Having some understanding of that seasonality in your business and long-term trends and highs and lows in prices is very important. When you are ready to sell, sell at the top, avoid the bottom. Where do you sell at the top? Well, here's an example of the 2011 December corn weekly futures chart. When you know the high or the record high for corn, and you know it's been, $8.49, and as you get closer and closer to that level, you need to be aggressive sellers. Some years prices are higher than others, and some are lower. Learn to adjust your expectations. If you're at the bottom, be patient for markets to turn. Remember, Babe Ruth never batted 1,000, but he was one of the very best that ever played the game of baseball. Do not expect perfection or the top 1% of prices, because if you do, failure will most likely follow. All you are looking for is top 25, 33%. If you can achieve these percentages over time, you will become a very good marketing expert. Our second topic is know your cost of production. Don't forget to have some understanding of your cost. Futures do not care about your cost of production, but knowing when to take a profit can help you pull the trigger. So knowing that break even is important. When market prices are high, do not be afraid to be an aggressive marketer, and vice versa. Futures price on Chicago is just that. So do not forget to convert that price to dollars per acre or dollars per bushel. It can help you pull the trigger more often. Our third topic is to get to know basis. Remember, do not live in the past. We can't change the past. All we can change and worry about is the future. Learn from your mistakes. Price risk is your biggest risk, not basis, but you cannot ignore basis entirely. You need to focus on basis. Understanding historical highs and lows in basis, just like you do with futures, when the time is right, is important to pull the trigger. A positive basis plus another positive futures price equals a greater plus number. That's simple math. So get to know your basis, get to know your futures historical ranges. Remember, doing a basis first contract is committing to delivering bushels at harvest. A futures first only contract can always be bought back if futures are lower because you were not able to plant enough acres or the yield is lower than expected. So a lot of farmers don't like to do the futures first or whatever the case may be because they may not have the bushels. But if you're doing these contracts, whether it's basis at historical good plus number or a futures first contract at historically high futures level, what's your risk? Your risk is that you don't have the bushels at harvest. Most likely the price is going to be lower and the elevator will owe you the difference. Only book for up to 100% of your guaranteed bushel yield. Don't get too aggressive. And again, please do not get too aggressive with shorting futures at 100+% of what you think your actual yield will be. If you don't know what you're doing, you get caught and you can end up losing a lot of money. For the remainder of your crop, use storage or futures. So you're going to book up to 100% if you're comfortable, your guaranteed bushel yield, and then the rest we can store at a future date. The best basis is typically at the end of the year, just after Christmas. That's when local elevators are looking for more bushels. That's when the farmer really is not selling. Our fourth topic is you need to keep an eye on the managed money crowd, the speculators. In this example with the chart, we're showing you whether the managed money are long or short. Long meaning they're buying contracts, they're bullish, they think the price is going up. Short meaning that they're sellers, they think the price is going to fall. So don't ignore these managed money and index fund speculators. They continue to add more money to the commodity complex every year. They are your friends, not your enemies. When they're very long at seasonal highs, you got to sell into that strength. Here's an example of the 2011 November corn oil daily futures chart, and I've highlighted where perhaps the funds are very short When they were bearish or very short, the markets just ignored them. Take a contrarian view. It works for me. The funds in the USD have increased the volatility by 50% over the last 7 or 8 years. In other words, the price of corn can go up by 50% in quick order, but it can also fall very quickly as well. And you know that when it falls faster than when it went up. Our fifth topic is to keep an eye on China. Do not ignore China. It's the second largest economy. Eventually it will be the largest economy in the world. It's buying a lot of the resources that the rest of the world has, and it creates a lot of demand for beans and corn and wheat and so on and so forth. Growing incomes are demanding more grains and protein consumption. Feed demand also continues to grow, causing export demand to increase. Keep an eye on the political landscape as well as global trade policy and export bans. Watch the stocks-to-use ratios both in US and globally for perspective. The sixth topic is to take into account currencies. Do not ignore the currencies. Keep an eye on the US dollar index. A lower US dollar index is good for exports. A higher is the opposite. A Canadian dollar, if you're a Canadian producer, you need to keep an eye on that Canadian dollar. If you're a livestock producer, a higher dollar is negative for your bottom line. A lower dollar is good. If you're a cash grain producer in Canada, in some cases, that Canadian currency, a lower currency, is good for basis. The opposite if it moves higher.